Hello and welcome to an exclusive next level webinar. The title, Achieving Liquidity from Illiquidity, How to Exit a Real Estate Limited Partnership, a topic that we definitely have not even scratched the surface on, I think, on next level webinars yet today. So really looking forward to this one. I'm your host, Adam Carswell, joined by my co-hosts today, Mo Bina and Shah Ahsan, and we are joined by Simen, Ruge, and Jackson Stith of Syndicate Capital. So before we get in here, I just want to say hello again to our co-hosts and our guests, break the ice a little bit. We'll start with Mo, then Shah, then to our featured guest. But Mo, Shah, how are you guys feeling today, and what are you looking forward to learning?
I'm excited. Go ahead. Oh, sorry.
Go ahead, Mo.
I'm excited. This is like you said, Adam, this is a conversation and a topic that is rarely talked about. So I hope a lot of people get a lot of value out of it today, and I'm certainly looking forward to it myself.
Same here. I mean, this is a topic that I feel like a lot of people are not really well informed of. I mean, heck, even a couple of months ago, I had no idea about, all the various options that you have as a limited partner, as a general partner for exiting partnerships. So I'm excited and I'm looking forward to today's discussion.
Definitely. Before we get into the bios of Simen and Jackson, do want to just say hello to you guys as well. Looking forward to this. Any opening remarks we'll start with Simen and then Jackson.
Hey, Adam. Great to be with you. Thanks for having us on. It's always a pleasure to come on to these webinars and talk about what we do. As Shah mentioned, it's not an area of the market that so many people are familiar with. So it's always great to do these kind of educational things or, highlight the things that we do every day. So thank you for having us.
Yeah, I'll second that. Thank you so much for having us. Great to be here. Great to share our knowledge and expertise with you guys and to reach a broader audience, which is your audience. So thank you so much for having us on.
Grateful to have you guys. Thank you for taking the time out of your calendar to invest it with us here today. And everyone who's joined us here live and listening on the replay, thank you for investing your time with us as well. Let's go ahead and get that chat box warmed up now. If you are here in the audience, go ahead and punch in, who you are, where you're tuned in from. And I thought of this one before we went live today. We'll go ahead and throw a bonus one in there. Give us your favorite beverage. I know Jackson was telling us he loves red wine before we got started today. So go ahead and put your favorite drink in there. And yeah, hey guys, I mean, you're going to get a massive amount of value out of today's conversation. We'll reiterate it one more time. Not a lot of other places to find the information that we're going to cover here today. If you are joining us on the replay, be sure to give us a thumbs up, drop a few comments, like the message, share the message, subscribe on the platform you're tuned in on. Really would appreciate that as far as perpetuating this presentation. And also the show notes connected to today's message. And if you're on the Dream Chasers platform as well, make sure you check out all the links there on the Dream Chasers platform. That'll be important to check out the video version of this replay. So here we go. It's time for the presentation, Achieving Liquidity from Illiquidity, How to Exit a Real Estate Limited Partnership. And you know what? I've got their formal bios here in front of me, and I'm going to get to those in a second. But I guess that we should paint the picture here a little bit on how this day came to be before we get started. And I know Mo and Shah were basically like, hey, Adam, we really want to do this webinar. We think this would be a great fit with what Jackson and Simen are working on. And we had a meeting not too long ago, started going down the rabbit hole and figuring out, okay, this is what we're going to do. This is what we're going to do. And so for me, it's been cool to see how this has come together, but I'm wondering, Mo and Shah, if there's a little bit more to the backstory of how we got here today that either of you two would like to share.
Absolutely. I'll start. I actually watched Jackson and Simen present on another webinar, and I immediately thought to myself, I was like, man, these guys are doing something that not a lot of people are doing. It's a very niche area, but an area that, is extremely valuable, especially now with the growth of crowdfunding and syndications. And I kind of foresaw it back then. I was like, I'd love to have these guys on to some kind of podcast or webinar. So this is it's great to finally see this thing come to fruition, and to have this webinar on a topic that doesn't really get a lot of attention, unfortunately.
Yeah, and I'd like to add, just as an investor, there's many times when people, for whatever happens, there's a liquidity event, or they need to undergo a liquidity event, and they want to get out of an investment, not because the fundamentals of the investment have deteriorated, but just for the sake of like family emergency or unforeseeable type of event that happens. And, this is a good topic, for people to understand that there are potential exit strategies instead of being locked in. So.
Love it. All right. So here's my Cliff Notes version of both of Jackson and Simon's biographies. Quite the resume for both of them. But I'm looking, here's as soon as you see Simon's biography, you see prior to that he was in investment banking in London. Has worked with companies such as Barclays, UniCredit, State Street. Man, as soon as I get to, I'm like, all right, now where do I begin? Quite the resume. Let me just do this, guys, because you guys have clearly earned your stripes, put it that way. You can, everyone, if you want to go to syndicatecapital.com and follow along as we do this, we'll do that. But Simen, we'll start with you, and then Jackson as well. I mean, you guys, I don't know where to start is the main thing with your credibility leading into today. So could you kind of, in that order, just walk us through your background, and then we'll get the presentation going.
Yeah, certainly. I mean, Jackson, do you want to start off, or
Sure. I'll start off because it kind of ties in with where Syndicate Capital kind of formed out of my experience, and you'll see as I explain. So my background is all real estate development and acquisitions. I have about 15 years in heavy real estate development experience. Put up about $9 billion worth of stuff all over the world: Dubai, Las Vegas, Miami, New York, Texas. And there came a period in my life when I didn't have a job. There was a financial crisis. I was in Dubai. I went back to Texas. I hung a shingle. I did some consulting work, sort of, development consulting work. And then I also started syndicating out value add opportunities in multifamily mostly. And I attracted investors who had a stronger balance sheet than I did. I took an LP position in exchange for putting these deals together. And there came a time when I thought the cap rates had compressed enough and we had made enough money on paper. I wanted to convert that financial gain into real hard cash, right? So I said, let's sell the properties. And I said, we love the properties. We're long-term holders. We're already wealthy. We don't need to sell. We just want to sit here and collect rent. And I said, I'm in a different place in my life and my wealth creation. I want to get some of that cash and do other things with it. They offered me, about 65 cents on the dollar to the net asset value. And I said, that's really not good enough. I went out, scoured the world, and I said, who is an intermediary that can help me with this? Found none. I went on, ultimately we negotiated a fair price, and I'm thankful to them for that. I went on and I did some more development work on Fisher Island in Miami. And it's in Miami where I met Simen. And I always had this idea ruminating in the back of my mind, like, this is a real problem. There's no secondary liquidity and there's trillions of dollars of this stuff, surely, right? And when I met Simen, I had identified the problem, and Simen, really from his background, which he'll get into, has expertise in illiquid assets. And we were just kind of meeting socially, and I described this to him, and he, much to his credit, he went off silently, came back about 2 weeks later, and he said, I think you're onto something here. I think I can help you do it. Should we do it? And that's how our partnership came to be. So Simen, why don't you tell them a little bit about yourself?
Yeah, so I'm not a real estate person by training or by professional background. I studied economics, monetary policy, central bank things. Then I went to work for a couple of different investment banks in London. I worked in institutional sales for them. I focused on interest rate products like derivatives and bonds, and spent a good decade on a couple of different trading floors, selling to pension funds and bank treasuries and things like that. And after 10 years in London, Brexit happened, which I'm sure you're familiar with. And I was working for Barclays at the time, and the team that I was part of was moving to Paris. And me and my wife was kind of looking at the option of moving to Paris, and we decided, for family reasons, we moved to Miami, where she's from. So that was for me, like, almost the end of a career. I spent 10 years there doing this very specific thing. Came to Miami, was kind of thinking, what's the next move? What am I doing? And I got introduced to Jackson, and he sat me down and told me about this market. And he, like, as a bond guy, like, you've been on so many different brokering expeditions into various sub parts of the bond market, and there's always intermediaries, and it always, like, And there was always liquidity isn't great, but you're always able to shift something around, even in really esoteric instruments. So when he told me about this market that had no intermediary, and in addition, I was like, so what do these things yield? And he's like, well, I mean, you're talking double-digit percentages. So I was like, I was sitting there drinking my beer, and I was thinking that this could be really interesting. I've come from a world where I've sold securities that, in some cases yielded negative interest rates. And you're telling me you can't find people to buy stuff with double-digit returns. So I sat down, and then, from there started really a long process of figuring out how you do it. Because it's not a straightforward part of the market either. As we'll come into, it kind of falls between different chairs of what is the traditional real estate market and what is the capital market. So that's kind of where we came from. That's what I bring to the table. This idea that you can find buyers for the most interesting assets.
I love it. I love it. Thank you for the context there. Yeah, you guys see, you did much better than I could have on the on the intro. So thank you for the backstory. It's all about the story. It's all about finding out how these moments in life come together. So Simen and Jackson, thank you. The way we are going to do the presentation today, we actually have a series of questions from Mo and Shah that are going to help us really go deep into this sector as far as maybe they could be considered FAQs. I don't know. I'm sure Simen and Jackson, you guys get a lot of the same questions. We'll find out. But without further ado, I do actually want to hand the microphone over to Mo and Shah. I guess, Shah, if you kind of want to cap things off here and begin your, your back and forth dialogue with Simen and Jackson. Really looking forward to it. The microphone is yours.
Thank you, Adam. So Simen and Jackson, you guys described, a little bit about yourselves and what prompted you to start Syndicate Capital. Traditionally speaking, like if you were, let's say, a limited partner and a general partner seeking a liquidity event, what were your options?
Well, it's kind of like Jackson's story, right? So maybe you want to go on and elaborate a little bit on the history of this, Jackson.
Yeah, so I think what I'll do is I'll address the LP and then I'll let Simen chime in for the GP recapitalizations, right? So a limited partner in almost, every deal is different. It's all papered differently, but let's just say the vanilla textbook example is a limited partner is a limited partner. They're a passive investor, and unless there's, fraud or some other major event, trigger in the partnership documents, they really don't have any rights to affect any changes to the operating business, to the business, right? So, and in addition, in most of these partnership documentations, they don't have the right to sell their position to another third party without the general partner giving their approval, because these are all private deals. They don't want just anybody coming into the deal. They could be disruptive, so on and so forth. So it's limited, right? It always has been very limited because of illiquidity, lack of marketability, and these legal mechanisms within the partnership documents. So a lot of times, just like in my case, you go back to the general partner and you say, I need liquidity, such and such happened in my life, I need cash, I got $1 million with you, what can you do for me? And most general partners are in the business of doing deals and spreading their capital as thinly as possible across many deals so they can get the fees and they can generate the higher returns on that capital and so on and so forth. They often buying a limited partner back often is not, their primary desire in life. They want to go on and do other deals. So they typically offer some sort of discount, and a pretty deep discount. We've heard horror stories from people where they're getting offered 40 cents on the dollar, and there's nothing wrong with the deal. It's just a matter of leverage, and it's a matter of not having other options. So for the vast majority, syndication's really been around for about 100 years now. For the vast majority of that time, people were either selling back to the general partner or other limited partners. Now there are recapitalizations that happen when you're rejiggering the entire capital stack, sometimes maybe finance out or the GP refinances, and they've held it for 10 years. So there's so much value that they can then buy the LP or all the LPs or one of the LP or whoever wants out the deal out with those refinance proceeds. But it's really been internal, right? And so what we've really tried to do and are doing is creating a second alternative to that very private, very internal, insular world where these positions get traded back and forth inside of that LLC. And I think we're creating some real success and some real traction doing that. You know, it's given people an alternative, and now they're realizing, you know, it's a psychology change as well. Like I said, it's been 100 years where a syndication is syndication is syndication. Everybody thinks you get in, you can't get out until the GP says so. Well, some GPs just want happy partners in their deals, right? They don't necessarily want to use their leverage or their control rights or any of that. You know, they might want that LP to recycle the capital into another deal that he's doing, right? And he wants to have a good track record and a good reputation out there in the market, right? So there's plenty of GPs that are like, look, as long as whoever is coming in, you know, is a good guy, isn't going to be disruptive. I do my background checks. I make sure that, you know, he's not coming in here to cause me trouble. Then let's talk, right? So I think that covers the LP. I'll let Simen speak to the general.
Look, I mean, there's a big caveat to all of this, right? You talk about the history of, you know, are there other intermediaries to do this? And there's the big caveat is obviously, if you own 10% of a Manhattan office building, there are people that will help you do this. And there's always been, they're called investment banks, right? Once you get to a certain level or there are boutique shops that focus on the bigger tickets. There are funds that will buy them directly from you, but they need 20, 30, 40, $50 million tickets in order to be interesting for them, right? So for the vast majority of what we call the middle market, this function was more informal. It was usually with the GP itself. Or some informality through your network. You might have known a guy who was looking for that kind of position, and with a friendly GP, you managed to affect the transaction. But, you know, predominantly when we speak about all of this in the middle market, you know, there were some niche players, but most of it is very informal. And then when it comes to the GP side of this, I guess this is, you know, both in the bigger scale of things and in the middle market, this is a newer part of it, in that as a GP, you might find yourself with legacy equity. You know, as you've done projects for 20 years, you're sitting with positions that potentially have a lot more value than what you put into them. And then comes the pressure to do more business. And as you probably, I mean, as everyone knows, in a stressed market is when you find the best opportunities, but then financing might not be the best, right? So where do you, it's a little bit of the catch-22 of the best opportunities come along when your availability of financing is probably the worst, right? So here's another way of accessing some of that legacy capital by drawing that down and selling some of it off. So that's a different part of the business as well.
And for those that may not be familiar with kind of like the phrase of like middle market, like, can you just give like a brief overview of kind of what you mean in terms of like the size of middle market and how it kind of pertains and relates to commercial real estate specifically?
Sure, I'll handle that one. So, you know, we consider middle market any piece of real estate that is $100 million of value or less, right? Maybe in bigger markets like LA, or more expensive markets, LA or New York, Boston, Chicago, that valuation might go up a little bit, right? But in general, $100 million or less. You know, this is, you know, garden style apartment complexes, 300 units in Patterson, New Jersey. A retail strip center with a Hobby Lobby anchor in, you know, Hialeah, Florida. You know, a Motel 8 on the side of the road and, you know, outside on the outskirts of Philadelphia, Pennsylvania. This sort of thing. We're not to, as Simen alluded to, you know, if you have a, you know, $750 million tower on Madison Avenue in Manhattan, you know, and you own $100 million of that in equity, you're probably just turning around to your investment bank and asking for help in that. But if you have $10 million in a garden style apartment in Hialeah, Florida, you know, they're not going to pick up the phone call. We will pick up the phone call because that's the market we deal in, right? So the ticket sizes we see are typically, you know, 5, 10, 15, sometimes up to $25 million. We've seen things on multiple tranches of transactions up to $65, $70 million. The lowest we've ever seen is probably $800,000. But those are few and far between, you know. It's the real sweet spot in the market seems to be the $10-15 million ticket size. And that's straight equity ticket size, right?
So when we're talking about a liquidity potentially for an LP, we'd be talking about, of course, we'd be talking about a fraction of that, let's say $10 million or so. In terms
No,
of
that's an LP position. I mean, look, they all range, right? It just depends on how the deal was capitalized at the outset, because maybe the minimum was $250,000 and maybe the minimum was $1 million. Right. So the minimum investment when they put the deal together, that is. So I'm just saying the market that we seem to be dealing with, right? And like, if someone has a $500,000 position, we'll talk to them and see if we can move it for them, right? But what comes to us seems to be $10 to $15 million, maybe, you know, kind of in that range. And that's squarely middle market real estate. That's, you know, one or two LPs in a garden style apartment in, like I said, Patterson, New Jersey, or whatever the case may be. Just a couple of wealthy individuals or that put money into this deal with a real estate developer that they knew, and now they, you know, need a shift out of it for various reasons. And, you know, they come to us. I hope that answers your question.
Yeah, thank you.
Thank you. And so Jackson and Simen, when you know, when people, or one of the misconceptions people have about a limited partner wanting to exit a deal is that they just assume that it's distress, but that's not always the case. And Mo kind of touched upon this earlier, but in your experience, what are some of the common reasons why an investor may want to, let's say, exit a deal?
Well, maybe I'll take this then. I think, you know, a common denominator is time. The time horizon of a deal is always the big problem. So it could be anything from the fact that when they went into the deal had a 5-year horizon, and at the 5-year horizon they were supposed to get their money out, but then someone decided to prolong it. So it could be as simple as that, you know, the majority, let's say you find yourself in a deal as a minority LP investor, and the other investor in that deal is a pension fund, and the deal is running very well. And the pension fund is close with the GP and says, look, we'd quite like to keep this thing running. And the GP says, well, there's nothing in the document stopping you from doing that. And you find yourself in a ride that's a little bit longer than what you want to do. So that's one. A lot of the time it's a personal event. Let's say, you know, death, divorce, these kind of things, where there might be a change of ownership. You know, whoever inherits the LP interest doesn't want to hold on to it, has a different need. You might have a different need for cash in your life. I mean, people at some point have to pay for the kids to go to college. You know, you might want to buy that house in Florida you've been dreaming about. You know, there are a lot of different reasons. I think the common denominator is that when you make investments for a really long time, even if you really, really try to estimate what your life is going to look like in 10 years, it's hard to be exact about it. And stuff happens. So that's kind of one of them. And then there might be just a simple rebalancing, like, you know, in the last, you know, during this pandemic, there's been a big shift in preferences around what people like in the real estate spectrum. You know, like retail is not a big hit at the moment. Office space, there's been some big questions around. So like if you're an investor and you're sitting on a lot of office space, you know, maybe you're looking to rotate out of something like that. Maybe you could find an investor that has a different view on that. In some of these contested areas, there might be some difference of opinion on what constitutes a good deal, and you might be able to, you know, exit in a sector of the market you have less belief in and go into a new one you believe in more, or something like that. So there's both this kind of life event side of it, and there's a reallocation side of it, which I think is interesting.
Right.
So if I could add to that,
Go ahead.
that extends to, you know, general partnership recapitalizations, right? Just to speak a little bit on a deal that we are onboarding, in the process of onboarding, in a partner, and this general partner put several deals together with the same group of limited partners, and the limited partners basically said to him, sure, we'll invest with you as long as you put a tranche of preferred equity in here. Well, preferred equity is expensive, right? And so they came on board contingent upon that. He was never that comfortable with it. So now he wants to clean up his capital stack. like in the case that I described about myself earlier, they've made some money on paper. He has this piece of preferred that's ticking over at 12 or 13% interest, whatever it is. And some LPs that would not want to be in the deal any longer if that piece of preferred goes out the door, because then their IRRs, their cash on cash comes down. That's how they're juicing their returns, right? It's on their common equity. So, going back to what Simen was talking about, it's also a rebalancing of the capital stack in some cases where, look, we're just going to bring in one big LP. We're going to take out this preferred chuck. We're going to take out these LPs who require this preferred equity in the capital stack. We're going to clean it up. I'm going to get a nice clean capital stack with one LP that doesn't have that requirement, right? So that's also a case where these kind of transactions transpire.
You guys have touched upon this already a little bit, but in terms of the quite a bit of the deals that you see coming your way are liquidity events, on the GP side. So what are some other reasons perhaps that maybe a GP or one or more GPs may want to exit out of a deal? Simen did mention about changing in perspectives, perhaps, especially like with office and retail going through some transformation right now. Perhaps, there could be life events and perhaps perspectives and other things that change, someone's position in these deals because they're so long-term and, multi-year hold periods. But what are some other reasons why a GP may want to exit out?
Yeah, I think there are a couple of different things there, right? So we can kind of class them into two things. One being GP-led deals, which involves LP capital in the deals they have, where they're in the driving seat and they're kind of replacing one investor for the other. So that's one where we're working for a GP to do something about the LP capital. When it comes to the GPs themselves, it's going to be very difficult for an LP to cleanly exit the deal and leave their LPs inside. I mean, it's a bit like abandoning people on an island, right? So it's probably not going to work that well. But a lot of these, a lot of legacy deals that run for a while have quite punchy, have done well. There's some excess equity there. You might be in a position where you can bring in more LP investors. You might be able to take some of your own chips off the table. And, a lot of the times, this is also something that's interesting in how a project comes together. Like there are different stages to development. Like I'm telling you guys stuff already, but like you start off with a piece of land, you build a building, you stabilize the building, and then all those phases are different. And through all those stages of development, there's a different risk profile, right? So let's say you bought a piece of land and you want some investors in to help you build a building. That's a very different risk perspective than say, I want to buy a building that has tenants that's paying an income at the moment. Those are two different classes of investors. The group that likes the construction and development side of it is not going to want to sit and earn income for 10 years. So you might have these kind of handover periods where you say either the GP has footed the bill himself, developed the building, and now stabilize the building. And they can take some chips off the table both through a refinancing, but it can also get some other investors who just want to hold this for a very long time. That's one way of looking at it. And then you can also, you can essentially tap into a different type of investor base and recycle the deal a little bit. So these are interesting things you can start to look at and do, right? And kind of, play more to the investor preferences rather than believe that you're going to sit with one set of an investor base through the entire life of the deal, or that you have to sell the building after development, after stabilization. You could just tweak the investor base and that way hold on to the deal. So there are many different things. Jackson, did I miss anything here? Sorry, I mean,
yeah, well, no, you didn't miss anything. Just to go back to the refinancing, right? That's not always an option for a couple of different reasons. Maybe you already have really good debt on it and you're not willing to try to do that, right? Like maybe you have really low interest debt with really long amortization with a bank that you like and you trust, and like you just don't want to refinance. So another way to tap some money that some equity that's been built, right? Hopefully you're creating value if you're a real estate guy, is to recycle some of that equity that you've built up over the past, whatever it was, 3 years since you bought it and did work and upped rents and so on and so forth. Maybe you don't want to refinance because you like the loan you have in place, but you know there's a chunk of money there that you can get some liquidity for. And so this is a mechanism to do that.
That's a great point. Yeah, if I'm a GP and I've got a 75-25 split and I've added a lot of value, and I want to still maybe stay in the deal, but I want to maybe cash out a little bit of the value that I've created, you know, for myself and for the LPs, then this would be a great opportunity to take advantage of that then. So
call us, Mo.
of course.
It's really interesting you guys brought up the example of debt, because I was also thinking about deals where there's probably prepayment penalties involved, and you know it may not make sense for you to go with the refinance, but you may want some liquidity, and that's where you guys can come in and act as intermediary for investors, both limited partners and general partners seeking to take out equity, but without necessarily having to go with the whole process of refinancing, or maybe even incur prepayment penalties, which could drastically affect the risk profile as well. So just to shift gears a little bit, let's just say I'm an investor. Let's say I'm a limited partner and I've invested $1 million into a deal and now I want out. What would that process typically look like if I was to call you guys and ask you about what are my options?
Simon, you want to handle that? You're good with the process stuff.
Yeah, sure. I mean, I think a starting point is understand what you own, right? That's always where we start off. Have a conversation of, what's your situation? What's going on? What is it you do have? We'd probably sign some kind of NDA with you, exchange some documents, make sure that you have the right to exchange those documents. And then very early on, we'd want to have a conversation with your GP, because, the GP is the power in the room, a lot of these, the decision maker that needs to be in on this. You can come to us and say, oh, I want to get out, but if your documents say that the GP decides that, then we really need to have a conversation with them as well. So it's very early on, we need to have that kind of tripartite conversation. Once we've had a look through it and understand what you own and understand like who you are, who the GP are, it's incredibly important, like the track record and reputation of a sponsor. We can go ahead and formulate a plan. We will have some ideas on where this might fit. Like, we speak to a lot of different types of investors, and, no two deals are going to suit everyone. So initially we'll have a think about that. And I think initially what we do as well is to understand if this is really something we can place, because we don't want to drag people through a process if there's something we don't think we will have the ability to place for them. So very early on, we try to learn as much about what you have, try to understand how it would fit with investor demand, and try to understand what kind of pricing you might be able to get on that. We don't do valuation, like we leave that to the investors. We obviously could, but what we focus in on is trying to find a valuation range, trying to understand what something like this might need to be offered at in order to find demand. I think that's the key for us. I mean, and I guess another thing to say is that when we work with people, we work on a success basis, and we get paid, percentage commissions. So, if nothing happens, you don't owe us anything. On the flip side, the more money you make, the more money we make. So we're aligned on that area. And in that respect, our ambition is to get the best price possible. So valuation range is trying to find a starting point and then go out and try to maximize that demand. So in that second stage, we would go out and start marketing. Once we feel comfortable that this is something we can place and that there's substance to it and it's something that will fit our base, we can go out and we can start the marketing process. Hopefully ending at some form of auction process. Like some deals are very niche, some are more mass market. We've seen incredibly niche deals. We've seen very, very bog standard ones, and the amount of demand you're going to have varies from deal to deal. But the idea is to get you as much exposure as we can. So that's relative to the process. And then what I would also say is that my experience with syndications is shorter than Jackson's, but what I've found out that no two deals are the same. This isn't a stock of IBM. And this is certainly not a fund share in Blackstone's fund number 13. Once you deal with these smaller deals, there are idiosyncrasies. There are, things you got to catch. Like there is an incredible amount of, supporting documentation. So the process will not look the same for every deal we do. It will be slightly different. and that's just something that we deal with and we manage with the client.
Just to follow up, Simen, what are some of the things that affect a liquidity of, let's say, an equity position?
Well, I mean, ultimately it comes down to demand, right? If you think about liquidity in a straight theoretical point of view, you're wondering about bid side liquidity, right? And the bid side liquidity comes down to how many investors are in the market and how big they are. That's ultimately it. And then it's almost like a match. We're more of a matching service than anything else. So if you have something that is a very standardized size, let's say Jackson said, you know, if we have a position of somewhere between $5 to $15 million, there's a lot of people that would look at that. We deal with institutional investors. A lot of them would look at a size like that. So that gets us into a broader spectrum. If you come to us with $500,000, that narrows the spectrum down. If you, there are all these different factors that come down to your position specifically. But then there also is a business cycle, I'd say, and preference element to this, right? Different points of the cycle, different investor preferences will shift immensely. In just, you know, a matter of a month or even a week, you can have an incredible shift in appetite. I bet you there were people in January and February 2020 who were dying to get their hands on an office, who in April and May felt very different about office investments. So demand for that particular position will change immensely, not just from, you know, what it looks like itself, but the environment it sits in. So yeah.
Right. And I presume that the changes in demand will also likely affect the valuation of this equity position in the secondary markets as well, right? Because if I have $1 million and I'm looking to, let's say, get out, what are the, like, you know, am I going to get out at a discount, or am I going to get out at the full amount that I, let's say, invested? Like, how would it work, or what are some of the factors that would affect the valuation of this equity interest?
Well, it's a great question, right? Maybe I'll just start off a little bit. I'll hand it to you, Jackson. Because I think one key thing is, like, to get your money back means retrieving your basis. Now, the valuation of the underlying real estate might have moved massively over those years, right? You might have put 100,000 in. Like, if you did a deal in the mid 90s, you put 100,000 in, it might be worth 2 million now. Just getting your basis back is actually a massive loss to you, you know? So it links back to the real estate, and then try and understand within that specific asset class and market and these kind of things, what it is you actually own. And Jackson, I'll hand it to you.
Yeah, it also goes back to the documentation of the deal, right? Like, if there's certain rights that the limited partner has, and therefore that if, you know, the more rights the limited partner has in the deal, the more value that the position will be worth. If it's a very restrictive deal and this limited partnership position basically just has to sit there and take whatever the GP hands out, well, then it's going to be worth less. And that doesn't just go to the economic rights, but the rights to affect major decisions, the rights to, you know, the mechanisms that are contemplated inside those partnership documents will affect the valuation of each position very differently, right? If there's basically a mechanism inside of a partnership position that makes that limited partnership position very rigid, then it's going to be worth less than one that has more flexibility and has more rights to affect change at the asset level or at the operational level. So, you know, and the devil's in the details. I mean, you have to read through all of these partnership agreements, and we do that when we need to, but mostly it comes speaking with the LP and speaking with the GP, double checking the documents. You know, we're not lawyers, and just making sure that we understand what these different mechanisms inside this deal are, and you gotta be straightforward with that. They have to be straightforward to us, and then to the investor, we have to be straightforward to them. Like, you know, these are the opportunities of this position, and these are the pitfalls of this position. You need to make a decision whether you're comfortable with it, right? And so the valuation, something could be worth zero to somebody else, and could be worth $1 million to somebody else who's comfortable with that particular mechanism of that deal.
But I think that's such a good point, right? Because inherently, valuations is a very theoretical exercise. And what we're after isn't a theoretical value. We're after an executable price, right? So it links back more to demand, as Jackson says. Like, are there things that make it more and less attractive to another investor, rather than necessarily like, is there a model that better values this stake?
Loving it, man. You guys are going deep, trying to figure out where to hop in here. But I mean, we could definitely keep going, and we will definitely maximize our time here. We had a few questions come in from the audience, and then Mo and Shah, if you guys want to keep zoning in on this. Again, our attendees right now, feel free to ask questions. This is technically the Q&A portion. We'll start off, and then Simen and Jackson, we got two. I'll let you guys decide who answers which one. One from Wade, and that is, can you give an example of a deal that you're working on right now that you're very excited about? And then Allison wants to know, if you had to guess, what are the top 3 objectives that you face when working with clients? Or did I say objectives? Objections.
Objections. Why don't we start there? I mean, Jackson, do you have any objections when working with clients?
I mean, look, the objections usually come from the general partner. Sometimes there's so there's that limited partner level and there's general partner level, and arguably there's the investor partner level, but let's not address the investor partner level because, the buyer, the investor, the new buyer investor, like we were referring to, has the box that they want to play in, and not everything fits into that box. And those are their objections, right? It doesn't fit into what we're trying to do or what we like to buy. And we had one of those conversations today. But on the limited partnership, it's often price, right? Like limited partners, and we try to get the best price possible, but limited partners often will say, the latest NAV is my position's worth $10 million, because that's what the NAV is. And you got to look at them and say, yeah, but you've refinanced 3 times, you've tripled your money. And by the way, like, anybody getting into this doesn't know the general partner the way you did, or they have to have a different comfort. This can be a different comfort level, that general partner, and with the deal. And there's no liquidity to these things except for us, right? You can't just go sell it like you can an asset. So you can't value you do an asset. There's always going to be some discount, either large or small, for illiquidity, lack of marketability, so on and so forth, right? And for lack of control. So that's the biggest objection is, and it takes time, and we'll tell them, we think it will trade for a range of this to this. And slowly over time, we get bids back, and they see that we're pretty much on the ball, right? Pretty much on the money when we told them this is kind of where we think things will come in for. Some people want 100%, they walk away, and they're gonna sit there and wait for inflation to take them to that 100%, which will no longer be 100%. And some of them, like I did in my own deals, came to Jesus, as this saying goes. He goes, okay, all right, I see, I can get 80 cents on the dollar. That's a great deal. I'm out, right? The biggest objections, I guess, from the GP is, who's this new person coming in? I need to get comfortable with them. I want to make sure they're not going to be an activist investor. I want to make sure they're sophisticated and they're not going to call me asking about every line item in the quarterly financial statements I send them, and that I'm not going to have a problem on my hands, basically. That I'm not trading one problem with an LP who wants out for another problem, which is an LP who won't let me sleep at night. So I'd say those are probably the 2 main objections that we face. I don't remember the first question.
No worries. Yeah, the other one was, can you guys give an example of a deal that you're working on right now that you're really excited about?
Yeah, I mean,
So
I would say, I would just like preface it, like, because we're in the securities world, we're not soliciting investments here. We're not trying to sell anything. This is more for informational purposes, but yeah, there are tons of deals we're excited about. Maybe Jackson, you can say something broadly about what we're working on at the moment.
Yeah, so, a third, besides the limited partnership recapitalizations, the general partnership recapitalizations, those are 2 of our legs of business. There's a third leg of business, which is raising new equity. And it's the recapitalizations that really distinguish us from the other intermediaries out there raising new equity. However, because of the secondary positions that we deal with, we get introduced to a lot of very interesting concepts, a lot of very interesting people doing out of the box things. We also do standard straight, multifamily value add opportunities, things like that. Simen and I get excited about different deals. Simen gets excited about one deal. I'm like, it's cool. And I get excited about some deals, and Simon's like, I guess it's cool. If you like it, we'll do it, right? The deal I'm excited about right now is a new resort in the Caribbean. It's a new concept. It's an incredibly creative concept. I have the background in casinos from my time doing the Cosmopolitan Resort and Casino in Las Vegas, being on the development team of that. So I learned a lot about how these properties just print money with conventions and events and so on and so on. I mean, just obscene amounts of money. This guy has a really creative concept. I see it because I've seen it in the casino industry, and he's putting something together. I can't go into too much detail about it because I don't want to, for multiple reasons, but I don't want to run afoul of securities law. But it's out of the mold, and sometimes things come out of the mold and you're like, it's out of the mold because it's insane and it's never going to work. This is out of the mold, and I think it'll work. I think it's fantastic. I think he's really understood a niche that is vast in the convention world, and if we manage to put the money together for him and he expands his business, I'm sure one day he's going to go public, and it's going to be like a fantastic success story. So that's what I'm excited. Yeah.
No, look, I mean, for me, it's more broader than that. I think to see the market come back to life in the way it has in the start of January has just been insane. The first 3 weeks of this year has been like drinking from a fire hose. So that excites me. Deal flow, number of great deals in there. I love the niche that we're in. We get to see so many interesting projects at interesting stages, right? We're not just out there primary funding. There's some interesting creative stuff we get to be part of as well. So yeah, no, more generally excited about this year. Hope there's an effective vaccine and that we can get back on track in this world. But like, there was a bit of a roar at the start of the year, and that's always great to get back to. So yeah, excited about where the market is headed.
Good to hear. That's exciting to hear, and yeah, you can hear the passion in both of your voices, and especially Jackson. I mean, I'm going to keep that one on my radar now too, and kind of be like, yeah, you guys heard it here first, right? Next Level Webinars talking about this deal. So yeah, I mean, we've got a few other questions coming through here, but I know Mo and Shah, you guys have some follow up as well. So we'll give it to you, and we got about 5 minutes left to go. So have at it.
Absolutely. So Jackson and Simen, what's the minimum size of an equity position that you guys would be able to, work with?
Well, so we tend to focus on deals or ticket sizes that are bigger than $500,000.
Thanks, Dan.
That I would. Can you hear me, Jackson?
Yes. Sorry.
Yeah. No. Yeah, $500,000 and higher, and obviously limited by the fact that we stay within the middle market. I'd say there are a number of institutions we know that look at smaller stuff as well. We're not just going to turn that away at the door. I mean, a lot of the times it's just directing you in a different direction. But for us to get involved in, like, when you're doing a sort of a high touch service of working with someone and marketing, there needs to be a certain scale to it. And we don't want to overcharge what we do. If we get down to smaller deals, the percentages just look bad, and it's not really what we're there for. And it's not really value to the client either. So we draw a line at $500,000, and if someone comes in the door and has something smaller, I'm sure we can find somewhere to direct you. There are funds that buy these things directly from people. But that's where we step into slightly larger blocks. We know that there's an incredible forest out there of crowd-funded LP positions and things like that, like 10K, 20K, 50K. I'd love to be able to do something about that one day and try to introduce liquidity to that market. I know there's some people trying to do that, but it's not something we've been able to do so far.
Yeah,
Sounds
maybe
like
I should explain. Maybe I should explain why that is, right? Because what's important for everybody to know is that, Simen is currently, and I will be soon, registered reps of a broker dealer out of New York City. Since 1946, the Supreme Court of the United States has said if you're a passive investor in real estate, you own a security, not a piece of real estate. You own a security in real estate. So for that reason, trading these things is restricted, and it's restricted in such a manner that you have to be registered in order to do that. And that's why Simen got licensed and hangs his license with our broker dealer. And, because of that, and the KYC, the know your client, and the anti-money laundering and all of these things, there's a certain amount of money that we have to spend in order to onboard positions and people. And therefore, at a certain amount of position, it no longer makes sense because it just costs too much money to do. So, I think in order to bring liquidity to those really small positions in the market, you'd have to really basically set yourself up only for that, right? You'd have to consume large portions of that market in order for it to make sense and really turn over a lot of volume. And it's just not how we're set up. So we're not gonna tackle that now. Maybe it's sometime in the future, but not right now.
Well, one more question, Mo or Shah, I'll leave it up to you guys.
Yeah, I'd like to ask a question. You guys had mentioned earlier about investor preferences and how preferences can change. And I'm kind of curious. Do you see the investor preference? How much does that align with the middle market that you usually see? So how much is the alignment from maybe like the smaller retail investor who maybe invests as an LP at maybe 50,000 or 100,000 versus an LP investor that invests at $500,000 or more? Do you typically see that they have the same investor preferences and risk appetite?
Well, I mean, I think they invest in very different ways, right? Once you become a bigger investor in your own right with ticket sizes and these kind of things, you have, you start to discern more individual deals. You have more availability of deal flow. You become more picky, right? At least I've never dealt with the retail spectrum of this, but from what I understand, smaller ticket size investors usually tie themselves to a platform, i.e. maybe a cadre or maybe a GP that they know well, and they stick to that GP. So it's more on a kind of sponsor basis. While as investors get bigger, they kind of just more decide that, this quarter we're going to really focus in on getting some multifamily in the Sun Belt, and let's find a great sponsor that does that. Let's evaluate 5 of them, find the best one. What have they got cooking right now? But as an individual investor, like doing all that due diligence work is incredibly hard. So you're more relying on people to do it for you. So that's why, platforms like Cadre, like bigger funds, REITs, these kind of things are great for smaller investors. And this is obviously not a recommendation. People should ask their investment advisor what they think they should invest in. But that seems to me the way things are moving. It's really hard for, me as a person as well. Like I do this job. But then for my own personal money, if I were to sit down after I'm done in the office and read, more due diligence documentations and try to find the best GP sponsor in the Midwest to do an office building, it takes a lot of time. So that's why people hire professionals to do it. So I think that's the biggest difference, is that once investors become bigger and they become sort of your pseudo institutions, their single family office, or they're part of a multifamily office or something like that, they become more sophisticated in the stuff they look at.
Yeah, that's true. And I've also seen situations where a deep-pocketed LP will actually come in and actually dictate the terms of the split too. They may not like the 65-35 split, and they'll actually dictate that they think it should be more of a 70-30 type
Yeah.
split. And I've actually seen that take place because I've seen the documents actually get updated, and I was curious as to why that happened. And I asked one time, and I was told, oh, well, one of the big LPs didn't like the split, so it actually helped all the other LPs.
Yeah, absolutely. Once with big checks comes more power, and something that Jackson alluded to earlier is that there is almost this muddling of the line between the GP and the LP position with like a pseudo GP LP position, which is an LP position with major decisions or something like that, where you're sitting in the sidecar, like where you have some kind of preferential position, or you have more rights than others. So definitely, as you get bigger, you get more power.
Yeah. Thank you.
No worries.
Well said. Well said. Thank you. Thank you, Jackson and Simen, for investing your time with us here today. Before we continue on right now, what is the best way for anyone tuned in or listening to follow up and get in touch with you guys and ask any other questions?
Absolutely. Look, we have a website, syndicatecapital.com. On the website, you find our phone numbers. There's a contact form, or just reach out to us over LinkedIn. We're both on there. Send us a message. We're always happy to chat and get in touch with us.
All right. Well, ladies and gentlemen, thank you once again for investing your time with us here today at this next level webinar, Achieving Liquidity from Illiquidity, how to exit a real estate limited partnership. If you found value in today's message and you're with us here on the replay, one more time, be sure to drop some comments down there for us. Let us know what you thought about it. Share it with your friends, family, and network, and be sure to subscribe as well, because there's more of this coming your way. It really helps with the future performance of next level webinars as well, and helps us bring on more high profile guests like Simen and Jackson. So guys, remember, you can visit Simen and Jackson at Syndicate. Is it syndicatecapital.com?
Yeah, that's it.
There we go. Any closing remarks, Simen, Jackson?
No, I think I said far too much. Jackson, anything from you?
No, just to want to thank you guys again for having us on, Adam, Shah, and Mo. It's been great. Mo, call us. We're here for you. And anytime you guys want to chat again or have us on, we're here.
Yeah.
Appreciate
Thank you for
it.
coming on, gentlemen. Thank you.
Yeah. Mo and Shah,
time.
any closing remarks from you guys?
I just wanted to say thank you to Jackson and Simen, and thank you everyone for joining us, and thank you for everyone who's watching this, watching the replay on YouTube. We appreciate it very much.
Yeah, I second that. Thank you, gentlemen, and thank you for everyone listening as well too.
You got it. You guys nailed it. Yep. One more. Give it up for our rock star audience and crew here. Thank you for tuning in to this next level webinar. My name is Adam Carswell, and I was joined by Mo Bina, Shah Ahsan, and we were featuring Simen, Ruge, and Jackson Stith of Syndicate Capital. Thank you for tuning in. And remember, in all you think, say, and do, take it to the next level.